This charity is serving up more free meals than ever before. Maria is one of its long-term visitors. She has been cutting back on heating to avoid high power bills.
Everything is very expensive. It's not easy. Electricity is very expensive. The gas is expensive. And the water is expensive.
Are you on the pension?
Yeah.
So is the pension enough at the moment?
I don't think so.
The latest figures for August show that power bills have dramatically fallen in the past year thanks to government rebates. Fuel is also going down. Food prices are still rising, but not as quickly. So too are rents, but not as much as they were at the peak of the housing crisis. All of this is helping bring headline inflation down below 3% for the first time in 3 years.
These are heartening numbers, encouraging numbers, they're welcome numbers, but we're not getting carried away because we know that the monthly numbers can be volatile.
The Reserve Bank has been keeping interest rates high to stop people spending.
The Reserve Bank Governor Michelle Bullock has said that we do need to be cautious in interpreting the monthly data, that we have to sort of take it with a bit of a grain of salt. If we didn't have those energy rebates from the state and the federal governments, then headline inflation would have been at 3.1%.
There is nothing artificial about helping people with their power bills.
Pressure is mounting on the Reserve Bank to start cutting interest rates now that inflation is at its lowest level since 2021. However, the Reserve Bank pays attention to core inflation, which strips out temporary price drops such as those on the energy bills. And this number is still above its target.
Our view is that the Reserve Bank will be cutting interest rates by February of next year, but we do recognise the risk that we could get a rate reduction before Christmas. The worst thing would be is if we cut interest rates too soon, inflation started to rebound again.
We're no closer to an interest rate cut than we were yesterday. We're no closer to inflation sustainably coming within the target range than we were yesterday. We've seen Australian standard of living being smashed in the last 2 years. It's a disastrous outcome for Australian households.
The economy is barely growing and individually Australians are going backwards.
Our overall thesis on the Australian economy is that we're going to get a faster slowing in inflation than where the Reserve Bank is forecasting it to be.
That's really stressful.
The central bank says that the best way to help everybody is to bring down inflation, and it acknowledges that more people are relying on charities like the Salvos.
The face of homelessness has dramatically changed over the last couple of years to months now. People who got jobs, people who are in the workforce, but they're struggling to pay bills, they're struggling to pay rent, so they're coming into the cafe just for lunch, on their lunch breaks. We have had a few single parents coming in with their little ones, which is always a little bit sad to see.
As Australians continue to make difficult decisions.
Australia's biggest bank believes the latest inflation data reinforces its view that the Reserve Bank could be in a position to cut rates as early as December. Stephen Wu is a senior economist with CBA. He joined me earlier. Hi, Stephen. We've seen a big fall in the monthly inflation read, but the Reserve Bank Governor Michelle Bullock was at pains yesterday to explain it won't mean anything for interest rates in the near term. Can you explain why?
Yeah, that's right. I think when we heard from the RBA Governor Michelle Bullock yesterday, she did really preempt this lower headline inflation rate that we eventually did see today. So headline inflation came in at 2.7%. In other words, back within the RBA's inflation target. Now, obviously, the key, or one of the key reasons why this occurred was because of the impact from both the state and the federal government's energy bill relief rebates that has lowered electricity prices by about 15% in the month. That's why we did see such a large fall in headline inflation and see inflation now back within the RBA's inflation target.
The underlying rate came in at 3.4 from 3.8. Is it coming down quicker than the RBA's forecast?
Yeah, so exactly as you said, we did see the measure of core inflation, known as the trim mean measure, that came down to 3.4%. And this measure excluded in August both the impact of the energy rebates and also the impact from lower fuel prices as well. So from that perspective, this is a welcome fall in inflation. And I think it really would be tracking broadly in line or even a little bit weaker than what the RBA's implied profile is for inflation. So I think it does suggest that the easing in inflation that we saw in August was not solely because of these rebates. We are seeing broader disinflation occur across the entire CPI basket. And we look at the share or the number of items in the CPI basket where we are seeing inflation actually coming in below the RBA's inflation target. That's giving us a lot of comfort that we are seeing a very broad-based disinflationary pulse coming through over the most recent months.
The RBA will be looking very closely at the next quarterly CPI read due at the end of October. Where does CBA expect that to land?
Yeah, so I think to answer your question, you're going to have to look both at the headline rate of inflation and also the underlying or the core measure. Obviously, the headline measure will be impacted by those energy rebates. So we do expect quite a soft 0.3% in the quarter outcome on the headline rate. Whereas for the underlying measure or the trim mean, we do expect that to come in at 0.7%. Which would be slightly lower than what the RBA's implied forecasts are for the September quarter.
What does that mean year on year?
Yeah, so our year-on-year forecast for the trim mean is for that to be at 3.4% over the year to the September quarter, and that's going to be below the RBA's implied profile of about 3.5% or so. So I think, the recent inflationary data that we've gotten so far, so that includes not only today's CPI indicator, but also various other measures, surveys of businesses and the like. They're all really pointing to inflation moderating quite a bit in September. And we do expect that to mean that the RBA will be surprised on the downside when we get the latest quarterly figures in late October.
The CBA is the only bank of the Big Four forecasting an interest rate cut in December. Why do you believe that the RBA will be in a position to cut this year? What is it that the RBA isn't currently taking into account?
Yeah, so a couple of things as to why we are expecting a rate cut by year end. The first is, we are expecting inflation to come down a little bit quicker than what the RBA is currently expecting. So as I said earlier, 0.7% on the trim mean in the quarter versus 0.8% expected by the RBA. The second reason as well is you do expect the unemployment rate to be lifting a little bit more quickly than the RBA is anticipating. And also thirdly is we actually don't really expect much of a pickup from consumption as opposed to the RBA's forecast that is projecting a fairly strong rebound in spending as a result of the stage 3 tax cut. So I think the combination of these factors, that is lower inflation, a little bit of a higher unemployment rate, and also still quite subdued consumption, i.e. there's no real behavioural response to the tax cuts. Those things combined mean that we really do see the RBA in a position to cut rates by the end of this year. But we do obviously acknowledge that the risks do lie to a later start point and a later start point for rate relief for households.
But are there risks if the RBA does not cut in December and the economy is really starting to slow faster than forecast, given that the RBA doesn't have a scheduled meeting until February? Could 2 months be too long to wait if the economy is slowing more quickly?
Yeah, it's a good question. And I think it's worth highlighting that with this new schedule that the RBA now meets at, there's actually about a 10-week gap between when it meets in December and when it meets again next year in February, which is actually mid-February. So I think there's a really long time for actually things to evolve in the economy. And so we think that actually the data will evolve over the next month or so in a way that gives the RBA confidence that they can actually begin their rate cutting cycle by the end of this year. And the 10-week gap that we're going to have between December and the February meeting, we'll see even more of a sign that the economy is slowing and actually that rate cuts at the end of this year was the right decision. But a lot does depend on how the economic data does evolve from here.
Stephen Wu, great to speak to you.
Thanks for having me.